If you're done trading time for a paycheck and ready to start collecting passive income in retirement, then this video is for you. So stick around and let's get into it. Welcome back to another video from One Up Financial. I am your host as always, Eric Persogna, CPA, Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter. Today, I want to talk about passive income in retirement. And to start, I want to first define what passive income is, and maybe more importantly, what it isn't. I decided to ask ChatGPT to explain passive income, and here is the AI's response. Quote,
"Passive income refers to earnings that are generated with minimal effort or involvement after an initial investment of time, money, and resources has been made. It's income that comes in regularly without requiring you to actively work for it on a consistent basis."
I want to emphasize a few key words and phrases in that definition. So first, earnings with minimal effort or involvement. Second, after an initial investment of time, money, or resources. And lastly, without requiring consistent active work to maintain. Why do I highlight these words and phrases? Because I think a lot of times when people hear the words passive income, first things that come to mind are simple, or it's easy, or I don't have to do a lot of work. It's carefree. In fact, the word passive itself means not actively participating or exerting influence over. In reality though, true passive income is anything but simple or easy or carefree. In fact, passive income really isn't passive income until an investment of time, money, or resources has been made, just like the definition. And even then, it still might not be passive income if it requires a lot of time and a lot of work and maintenance on your part afterwards. A good example of this is monetizing YouTube videos, something that you're gonna find listed on every blog under the sun relating to passive income. A couple of facts here about YouTube. So for one, according to Forbes, top YouTubers, now these are people that have been creating content videos for years and built up massive following. Top YouTubers are earning around $5 per 1,000 video views. So to put that into context, that would mean that you would have to average about 1 million views per month on your videos to earn $60,000 a year in revenue. Not net income or passive net income, but revenue before expenses. Just to give some further context here, the average YouTube video gets around 5,600 views. So in short, it ain't easy, okay? If it was easy, everyone would be doing it. Now, granted, there are a lot of people that are very successful on YouTube, even some that are maybe not making millions and millions of dollars a year, but they're making $50,000 to $100,000 of income from their videos. That is great. It's not easy to do, number one. And number two, it's definitely not passive. Okay, these people aren't just sitting down doing nothing and collecting a paycheck from YouTube. They are putting in the work, they're creating content, they're monitoring that content, curating it, and making sure that they're continuing to deliver fresh and new videos to their viewers. So ideas like this, like passive income strategies like this, like YouTube videos, is more akin to kind of like starting a business or even a side hustle, in that it requires a decent amount of upfront time and there are some risks involved. And even if you put in the work and the effort and create a channel and start publishing content, there is no guarantee that you're going to get paid one nickel from YouTube. And if you're nearing or you're in retirement, I'm guessing you might not want to invest a lot of your time and energy into something that may or may not pay off in the future. You're likely going to be more interested in waking up, doing what you want, when you want, with whom you want, and not have to worry too much about when the next paycheck is coming in. If that's the case, then I think we need to revise the definition of passive income and remove the after initial investment of time, money, and resources part. Because if you think about it, if you're at that retirement stage, you've already done a lot of the work. Okay, you've worked your entire career, you've saved money, you've invested money, you started a business, you've grown that business, you've sold that business, whatever your journey has been, you're at the point now where you might not want to make a huge or any kind of investment of time, money, and resources. You just want to collect passive income and do what the heck you want to do in retirement. With that definition, things like creating ebooks and online courses and blogging, again, are all great passive income strategies, but for our definition, don't quite fit the bill. Okay, so in retirement, we want to focus on the earnings with minimal effort part and limited maintenance going forward, right? We don't want to have to do a ton of work after. Under this revised definition, here are 7 passive income ideas for you to consider in retirement. Starting with number 1, probably the most simple and straightforward, is just putting your money into a high yield savings account or money market account. Now, a few years ago, this wouldn't even show up on my list. Simple reason is that interest rates up until about a year or so ago were pretty much abysmal. Okay, you weren't earning anything more than maybe 1% if you were lucky on a high yield savings account. But now the economics are much different. The environment is much different. So you can get probably close to 4 to 5% in a high yield FDIC insured money market or savings account at a bank. Now, these banks are going to be probably online, okay? It's likely you won't find that kind of yield at your local branch. And the reason is that online banks are able to pay those higher yields because they don't have the overhead of bank tellers and brick and mortar branches. They're able to avoid those overhead costs and give depositors a much higher yield on their money. Now, one of the downsides to money market and savings accounts is that that yield isn't necessarily fixed, right? It's going to be tied to interest rates. So if the Fed decides to cut rates now or anytime in the future, that interest rate is going to come down. So your income, your passive income, could potentially decline in the future. So just something to consider. Number 2 passive income strategy is buying rental properties with a caveat. And the caveat is hiring a property manager. And let me explain. I used to own a rental property, and I actually have many clients who also own them as well. And believe me, they are great sources of passive income. But there's a big caveat. They're great sources of passive income if the property that you own has strong cash flow, and if you have good tenants, there's not a lot of turnover, and the property is in decent shape. It's not falling apart and doesn't require repairs and maintenance every single month or week. And last, but maybe the most important, is if you have a property manager or someone to help you manage that property. So let me explain. According to the popular Bigger Pockets podcast, they pretty much focus entirely on real estate. They are the experts in investment real estate. The average cash flow rate, or pretty much the net income you get from that property, less your expenses, excluding depreciation, is right around 7 to 8% of the value of that property. So pretty decent return on your investment. Now, that average cash flow rate does account for and include some tenant turnover as well as some general repairs and maintenance that you're going to need to make on that property. Okay, those are kind of built into that average. But obviously, if you have a lot of tenant turnover and you're making a lot of repairs and investments into that property, it's really going to eat into your cash flow. So it might not quite be a great passive income strategy in that case. But let's assume that the property has 8% cash flow rate, your tenants are great, very low turnover, and the property's in pretty good condition. So even if you have all of these things in place, remember, you still want to ensure that this investment truly is passive. So that means that when your tenant Billy calls you on a Sunday at noon as you're about to tee off, and they're complaining that the AC isn't working or that their toilet is leaking, you want to make sure that that call can be directed to a property manager to handle. Or at the very least, you have someone that you can call, that you can trust to handle all of those issues, all of those problems, because they are going to come up. And they always seem to come up at the most inconvenient time. Now, I know what you're thinking. Obviously, hiring a property manager, that costs money. It's not free. Obviously, that is something that you have to consider, right? Generally, it only makes sense to have a property manager or a company, a property management company, when you have multiple units, or maybe you have one rental property with 3 or 4 units that has really strong cash flow that you can afford to hire a property manager to manage some of those things so that you don't get those calls on a weekend or at a very inconvenient time. If you have that property manager or company in place, it really turns that rental property truly into a passive income source. Number 3, buying a small business, and just like with the rental properties, hiring a CEO. So let me explain. If you're not into, let's say, real estate, or just don't want to deal with the hassle of rental properties, then buying a small business could be another passive income option to consider. If you don't have someone locally to help source these new business opportunities, there are sites like bizbuysell.com and loopnet.com that are great online resources for businesses that are for sale in your area. I know this may sound overwhelming, right? Buying a business, especially if you've never owned a business before, and may even sound more cumbersome and involved than owning just a rental property. If you think about it, there are a lot of different types of businesses out there, more non-traditional. They don't necessarily have a ton of overhead. So for example, laundromats, automated car washes, ATMs, vending machines, just to name a few. These are, I guess, in a sense, maybe assets, but they really are businesses to some extent. They're just more non-traditional. They don't have a lot of employees. They may not require a ton of your time and energy to manage. But if you find the right one or several of these types of businesses, they could generate a decent amount of passive income to you. Similar to assessing the purchase of a rental property, you obviously want to do your due diligence with any business acquisition. So that is looking at a very minimum, cash flow. You want to make sure that you're paying a reasonable price for that business. So there's some research there. And equally as important is you want to make sure that it's as turnkey as possible. So for example, a manufacturing company with 10 employees might not be as easy to step into and run as, let's say, owning 4 vending machines and an ATM, right? So looking at that overhead, looking at what it takes to kind of operate the business and making sure that it's as efficient and turnkey as possible is very critical. Even if, okay, let's say you do want to buy a business that has some employees, like a manufacturing company, for example, requires maybe some more time on your part to manage. Even still, if the cash flow is there, and the profit is there, then you could consider hiring a CEO or a business manager to manage that business, or at least just handle the administrative stuff, maybe even the finance and the accounting aspects of the business, so that you really don't have a ton of work to do. You're simply just cutting a check for the business, putting the right people in place, and collecting your passive income. Number 4, renting your home. So according to Airbnb, up to 25% of their hosts are retirees. And the average host actually earns roughly $14,000 a year in income from renting out their home. So if you don't want to buy a piece of rental property or maybe even a small business, then renting out the asset or the home that you already own could be an interesting option for passive income. Now, I know what you may be thinking, right? You don't want a bunch of strangers in your house when you're trying to relax and enjoy retirement. That's maybe not ideal. I totally get that. But you could have, let's say, a trip planned in the coming year, or a vacation, or several vacations planned. Maybe you're just going to be away from your home for a period of time. If that's the case, then you could consider renting out your home during that time and collect some additional passive income to maybe help cover the cost of that vacation or that trip, or pay for future trips or vacations. I think it's important to address that, passive income doesn't have to be like from just one source. So just because renting your home might not afford you like all of the passive income you need to retire, it might be able to cover some of those retirement expenses without very little work on your part. There is obviously going to be some work involved with renting your home on Airbnb. So you have to make sure the house is presentable. You have to do some research on rental prices in your area and ensure that your property is maintained well after those renters come in. So there's some work, but it shouldn't be too laborious. And again, if you already own the asset, the space is there and you may not be using it, why not turn that passive income on? Number 5, renting your car. If Airbnb-ing your home doesn't sound too appealing, then renting out your vehicle could be another option to consider. There are car sharing companies out there like Turo and Getaround that allow you to turn your car into an income generating investment. That actually may be the first time the words car and investment have been used in a sentence interchangeably. Your potential earnings from renting your car will obviously vary, right? It depends on the make and the model and the mileage and your area and demand and various factors. But if you want to look at the average, like what the average person is making from renting their car, it's roughly $600 a month. So again, just kind of like with Airbnb, it doesn't have to be your primary source of passive income. That $600 a month could cover vacation expenses every single year for you in retirement. I personally never have rented my car on Turo or Getaround, but I've done a lot of research, and what the experts are saying is that if this is something that is of interest to you, then it's best to use what's called automated pricing and demand-based adjustments. Okay, so basically just letting the platform's economics and algorithms work to your advantage to determine, the optimal price that you want to rent your car at, and let those pricing adjustments go into effect based on demand in your area. Number 6, crowdfunding and peer-to-peer lending. This is basically when you become a private investor or a private lender. In other words, you're participating in what's called crowdfunding and or peer-to-peer lending. So that basically means that your investment returns, your interest income, your return on investment, your return on capital is coming from investing in or lending money to other people or other businesses privately. This isn't like buying equity in Apple or government lending money through treasury bonds, right? This is private lending to other people that need money or funding to raise some capital. And this is also referred to as private equity and private credit. There are a lot of platforms out there that will give you access to these type of investments. One of them that I use is called YieldStreet. And before I go any further, just want to say that I don't get compensated from YieldStreet. I don't get compensated from YouTube. This is not investment advice. This is merely for informational purposes only. So please consult your financial or investment professional before making any of the investments that I discuss in this video. YieldStreet, good example of a platform that gives investors access to a variety of different private credit and private equity type of investments that in some cases could yield you 10% or more per year on your investment. So for example, I was just on YieldStreet the other day and looking at the different investment opportunities, and one of them I thought was kind of interesting. It was a portfolio of loans backed by a power sports company. So think of like ATVs and jet skis. So the investment in a sense is you putting your money into another pool of loans or funds from other investors, and those loans are secured by a business that's generating cash flow. And that business in this case is a power sports company. And I think the projected yield on that investment was right around 13.5% per year. So pretty decent return on your investment. Now, as you can imagine, so 13.5%, 10%, these are pretty good returns, right? Now there's obviously going to be some risk involved here. Just like investing in stocks or bonds or alternative funds like private equity and private real estate, anything that's earning more than the risk-free rate. And the risk-free rate is the rate that you could get on a short-term US government bond. Okay, so right now I'll call that 4.5% to 5%. Anything that's yielding more than that, especially if anything that's substantially more than that, definitely has some risks involved. Okay, so you want to be careful when investing in anything, whether it's a publicly traded stock like Apple or Google, or a private investment, whether it's private lending or private equity that has a large double-digit return. Okay, there's going to be some risk there, so you want to be careful when making any kind of investment. And in addition to that, I should mention that with private equity and with private credit, that in order to access a lot of these investments, you have to be what's called an accredited investor. So you have to have a certain amount of personal net worth, or you have to make a certain amount of income per year, or you have to be a licensed investment professional. Okay, so there's certain criteria in order to be able to access these kind of investments that you should be aware of. Last but not least, number 7 passive income strategy in retirement is investing in stocks, bonds, mutual funds, ETFs, REITs, anything that is a marketable security that will pay you a stream of income. Now, obviously, this isn't a new concept by any means. I think most people are aware of what dividend-paying stocks and bonds are in the marketplace and the fact that they can pay investors a stream of income. But what I want to talk about today as it pertains to investing in these kind of securities is, again, we are looking for passive income, okay? So managing these types of investments takes time and takes a lot of monitoring and oversight and research to make sure that these investments continue to pay you a stream of income as well as maintain and hopefully appreciate in value over time. So much like I talked about hiring a property manager with rental properties and a business manager or a CEO with buying a small business, if you're going to invest in stocks, bonds, in the public markets, and even private investments, private real estate, private equity, private lending, like I discussed earlier, then it's a good idea to consider outsourcing that to a professional. And that could be either a financial advisor, or that could be a robo-advisor or an algorithm that just does it for you. Either way, what you're doing is you're outsourcing that work and that time so you don't have to do it on your own. Removes that burden off of your shoulders so you can focus more time on doing literally whatever you want to do. And in addition to giving you more time, a financial advisor or a professional will help you determine, okay, how much should I have in dividend paying stocks and bonds and real estate and et cetera, et cetera. And I bring that up because one of the most common mistakes I see retail investors make is their hunt for yield. All they're looking for are the stocks or the funds or any kind of investment that pays the highest yield, right? It's almost like, I think, some element of guarantee in their mind whereby they see a yield or a percentage that they can earn on that investment. And they think that that's guaranteed. That's just going to be an even stream of income, no fluctuation from here on out. The history has shown that that's anything but the truth, okay? If you looked back over the past 20 years and just focused on the highest paying dividend stocks or an index of just the highest paying dividend stocks, you would have found that index significantly underperformed the broader market, something by 1.5% to 2% per year over the past 20 years. Same thing goes with bonds, right? Back in early 2022, late 2021, some of the highest yielding bonds were those with long maturities. And if you were just focused on yield, you would have seen the value of those bonds drop considerably, like 30 to 40% in 2022. Another example is real estate investment trusts or REITs. That's a popular one for investors because, again, they pay really high yields. But if you were just to invest in, let's say, an index of REITs over the past 4 years, you would actually have lost money. So that means that you would have less money today than when you started 4 years ago had you just focused on real estate investment trusts. So again, hiring or outsourcing that management to a professional can help you determine what type of mix of these investments is going to be best suited for you to give you that passive stream of income so you don't have to worry about it anymore. What are some passive income strategies that are working well for you in retirement? Please let me know in the comments below or shoot me an email. I would love to hear from you. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.